Adjustment of accounts: retirement and death of a partner. On the retirement or death of a partner, his share of goodwill will have to be valued in accordance with the terms of the partnership deed, and in the absence of such a provision in the agreement, the partners will have to come to a mutual understanding as to the amount to be credited to the outgoing partner in respect of his share of goodwill. The retiring partner will then be paid out his capital, the share of goodwill he is entitled to, and the share of profits due to him that may have accrued since the last balance sheet to the date of his retirement. In case of a deceased partner, the amount ascertained as due and payable to his estate will be handed over to his legal representatives. For the purpose of ascertaining the fair amount due to the outgoing partner in respect of his share of the firm's assets, it sometimes becomes necessary to adjust the book values of the assets in order to bring them on a line with their then true values. The necessary adjustments, if any, thus agreed upon between the partners, will be made through the profit and loss adjustment account as already explained, and the result of such adjustments as shown by this account will be credited or debited to all the partners' capital accounts in their respective profit-sharing proportions. In order to avoid disputes and the consequent litigation which are so commonly experienced between the surviving partners and the representatives of the deceased partner, it is highly desirable that the partnership deed must be most carefully drafted and must include clauses clearly defining the manner in which the amount due to a deceased partner's estate is to be ascertained and how the accounts of the partners inter se are to be adjusted under such a circumstance. Such an agreement must indicate the procedure to be adopted in regard to the following matters. 1. The basis of arriving at the deceased partner's share of profits from the date of the last balance sheet to the date of his death. 2. Whether the capital of the deceased partner is to be taken at the balance standing on his capital account at the date of death, or whether the assets of the firm are to be revalued for the purpose of adjusting the deceased partner's capital. 3. The basis of ascertaining the value of goodwill in order that the capital account of the deceased partner may be credited with his proportionate share thereof, and 4. The mode of payment of the deceased partner's share. Where any such procedure is laid down in the partnership agreement, the same will have to be rigidly followed in ascertaining the ultimate amount payable by the surviving partners to the legal representatives of the deceased partner. In order not to cripple the financial resources of the firm, an arrangement is sometimes made with the retiring partner or the representatives of the deceased partner, whereby the amount ascertained as due and payable is agreed to be spread over a number of years, interest at an agreed rate being paid on the balance outstanding from year to year. In such a case, the ultimate balance as adjusted on the capital account of the retiring or deceased partner should be transferred to a separate loan account in the name of the retiring partner or the representatives of the deceased partner, as the case may be. The capital account of the retiring or the deceased partner will thus be closed. Adjustment of accounts on the death of a partner. It is invariably provided in the deed as to how the accounts are to be adjusted in case of death of one of the partners. Experience has shown that in majority of businesses a great deal of inconvenience is entailed, and the progress of the trade arrested, by being compelled to take stock on the day of the decease of a partner, in order to ascertain the proportionate share of profits accruing to the estate of the deceased partner. Besides, the question of depreciation of assets, the basis of valuation of tire stock, and such other matters will always be bones of contention between the surviving partners and the representatives of the deceased partner. In order to avoid all this, it is desirable that the manner in which the profits for the period elapsing since the last signed balance sheet and the date of the decease are to be computed must be laid down in the agreement in most clear and definite terms. The amount payable in respect of the share of a deceased partner is generally agreed to be spread over a number of years, in order that the business may not be overburdened with an immediate payment. Some such clause as the following is therefore often inserted in the deed. In the event of the death of any one of the partners during the continuance of the partnership term, his share of the profits for the current year is to be calculated according to the amount of his share of profits for the last preceding financial year of the business and the proportion calculated between the last preceding year and the day of his death, but he is to be debited with all drawings made by him since the commencement of the current year. The share of the deceased in the goodwill of the firm will be equal to his share of profits of the 2 last completed financial years of the business. The capital of such deceased partner as well as his accrued share of profits and goodwill bear 5% interest from the date of death to the date of payment to his executors, administrators or assigns. The whole amount due to the deceased shall be paid off in 3 yearly installments, the first of such installments to be paid within 3 months from the date of death, with a view to obtain the necessary funds to pay out a deceased partner's share of the capital, accrued profits and goodwill. Partners often take up a joint survivorship policy, so that the firm's cash resources may not be crippled in case of the death of any one of them. 1. The method that is usually followed is to debit the premiums paid to profit and loss account, thus treating it as a business expense. This cannot be said to be a correct method to follow, as it tends to obscure the true profit or loss resulting from the business, for the premium paid on a joint policy of the partners cannot in principle be treated as an expense necessarily incurred in the course of the conduct of the business. Besides, if the annual premium is charged off to revenue each year, there will be no indication on the balance sheet as to the existence of an asset which belongs to the firm. 2. The other method followed in this connection is to allow the premiums paid as a debit on an account-style joint survivorship assurance account or joint life policy account, and to show the accumulated debit year after year as an asset on the balance sheet. This method deserves to be equally deprecated inasmuch as the asset, under the heading of joint life policy account, will appear in the balance sheet, year after year, at more than its then surrender value, i.e., its present worth at each balancing period. 3. The best method that can be applied in this connection is as follows. Allow the annual premium paid to accumulate on joint life policy account, which will be shown as an asset in the balance sheet at its surrender value from year to year. B. At each balancing period, debit profit and loss appropriation account and credit joint life policy reserve account with the amount of the annual premium, in order to maintain the working capital of the firm is not affected. C. In order to bring down the joint policy account to its surrender value, debit the joint life policy reserve account and credit the joint life policy account with the difference between the debit balance on the latter account and the then surrender value of the policy at the end of each financial year. D. The joint life policy account balance will then appear on the assets side, and the joint life policy reserve account on the liabilities side, at the same figure. E. On the death of one of the partners, the policy amount would be realized, and this will be credited in the first instance to joint life policy account, from where the ultimate balance will be transferred to the capital accounts of the partners in their profit-sharing proportions, in the absence of any agreement to the contrary. F. The existing balance on the joint life policy reserve account will be wiped off by transfer to joint life policy account. In the next lecture we will discuss about the amalgamation of partnerships and adjustments on purchase of business by a partner.